Did you just know it's time inside the market that typically is going to show you returns, not time in the market? I hear about this from people all the time. They want to time the market. Greg, is the market, is it up, is it down? I'm going to wait until the market's down and I'm going to buy. I'm going to hold off on investing. Instead of monthly and systematically investing, I just want to put it all in cash and wait till the market dips and I'm going to get higher returns. Well, see, there's two problems with timing the market. Is one, you need to know when to buy and you need to get that right. And then two, you need to know when to sell and you have to get that right. So let's just pretend you had a 50-50 chance of getting this right. That means you got to roll the dice and get this right as well too. So you have to decide not only, which by the way, the majority of us, even the people that are paid to do this, can't do it. You got to try to get this right and you got to try to get this right. We say, oh, Greg, I don't have to get to the very tippy top. And then on top of that, which, by the way, if not tippy top, we go here, we could have still been better off here. Not only do we have to get those both right, but we have to overcome our emotions. We have to overcome the way that we're hardwired and our DNA is telling us to do. I want you to think about this, and this is the way I like to explain it to clients, of a clock. And so if I had a clock, and we know at noon, right there at noon, that's the high point of the market. At 6 p.m., that's the low point of the market. And we got our 3 o'clock, and we got our 9 o'clock. And so what the market's doing, if it looks something like this, we have a peak up here, that's noon, and then it's going down, that's coming down here to 3. And then we have a trough, the bottom of the market, and then it starts to rise again, right? And then we hit the top, and we're back at noon. So essentially the market's like this, and you can look at this from a daily perspective, you can look at this a weekly perspective. Typically when we're talking about this, we're looking at this from peak to trough, which would be a market cycle, right? So maybe there's a bear's trigger in here, a bull triggers in here, but peak to trough in a market cycle as opposed to day to day. See, here's the problem. If you look at it from this clock, and we look at this way, theoretically, all the returns come on this side of the clock, theoretically. Again, we're looking at the full cycle, not day-to-day, day trading. And all the losses come on this side. So 100% of the losses are going to be on this side of the chart. And 100% of the gains will be on this side of the chart. Again, theoretically, and we're also looking at larger time periods. So you might say, well, Greg, while it's going down, there might be a peak up here, and I might make money if I'm a day trader. If we think about this, then we split this in half again. So we split it in half here. We're going to split it in half here. And so what that means is that logically, right, we should think 50% of losses come here, and 50% of losses come here, and 50% of gains come here, and 50% of gains come here. And the problem with this is that's not accurate. If you study the markets over time, they go down really fast and they come back really fast. And quite frankly, the last 2 market cycles we saw, this has actually been an increase in terms of timing. And so essentially what I mean by that is this quadrant right here, so going from the peak down to the mid part, if you study the majority of market cycles, more of the losses happen here than happen here. On the same token, more of the gains happen here. And what do I mean more of them? I mean the time to get to there. So 50% of the gains still happen here. I mean, it's literally put it inside. But the time it takes to go from 6 to 9 is much, much quicker than the time it takes to go from 9 to 12. The time it takes to go from the top, so 12 to 3, is much, much quicker than go to 3 to 6. Why is that important? Because by the time the market is here, it's already happened so fast. You're going to sell here. See, the problem is this is so quick and this is so quick. Not only do you have to get these both right, you have to be able to react to it fast enough, and you have to understand it. Because short term, this is hard to see. Is that just one day that's down that much? oh, if it's one day and I have a long-term perspective, I should probably wait 2 days. I should probably wait 3 days. By the time you realize it's a new cycle, you're down here. And so you're selling now the majority of your losses. And by the time you realize it's up here, and by the way, we're emotionally wired to do that. Think about 2008. When did most people sell out? This is just looking at mutual fund flows. They sold out between 3 and 6. And most people bought back in. And I'm paid with broad generalities of just looking at mutual fund flows. That's one determination, one broad. But it has to do with the emotional psychology. So we believe at Beratung, it's not a good idea to time the market. It's better to be time in the market, right? Let's get all the cycles. Because I know that if I invest here and I give enough time, theoretically, in all market cycles, if I got 30 or 40 or 50 years and I just let it ride, I'm going to see the growth up to the top. I don't care that if it was up and down during that time period. So hopefully this clock analogy helps you understand one of the many reasons why we believe it's time inside the market, not time in the market. If you want to help stay in discipline, we would love to help you build your financial plan around time inside the market instead of time in the market.